Is there a fundamental issue here that these are for-profit companies? We are in a capitalist society, and really in the last 20 years, it's not enough to just have profit. The profit, Wall Street's expecting the profit to increase each quarter. Is that a realistic thing to expect? I mean, is that part of the problem in some way?
Truthfully speaking, a lot of the companies that you're referring to are not-for-profit. So
no, when I talk about the insurance companies.
There are a lot of insurance companies that are not-for-profit.
Well, I just got this this afternoon. This is an excerpt from a May 2009 report by Healthcare for America Now, which is not a completely unpartisan group, right? But here's what they say. Profits at 10 of the country's largest publicly traded health insurance companies in 2007 rose 428% from 2000 to 2007, from $2.4 billion to $12.9 billion, according to U.S. Securities and Exchange Commission filings.
The reality is, if you look at for-profit and non-profit in the insurance industry, they compete with each other very effectively. So at the end of the day, I understand that, to the public, some of this looks egregious. But the reality is that they operate on a thin margin of about 4%. You're just dealing with very large numbers.
But when you find out that the profit was $2.4 billion in 2000 and $12.9 billion in 2007, and at the same time all these premiums are going up, I think the natural question is, well, wait a second, couldn't some of that profit have gone to keeping the premiums low?
Well, a lot of profits do. They do go into wellness programs, et cetera. Everybody forgets that the big bad insurance company, is putting money in their pockets. But a lot of these programs exist because of the insurance.
But what would have been so bad if it stayed at $2.4 billion? That seems like a lot of profit. I think that's what what people out there would ask.
Well, the reality is that every 3 months, the for-profit insurers have to disclose their earnings and their results. And there is the expectation from Wall Street, from the investors, that they have to do a little bit better to ratchet down their medical cost. And that is a term that's, I'm getting into the weeds here, but it's called the medical loss ratio.
Loss ratio.
Which is a very key term here. It's hard to understand a little bit, but it means that since 1993, the amount of money that insurers take in and actually pay out in claims has been shrinking every single year. And that means that more of that money is available for profits. You're right, there are some portions of that premium dollar that is used for care management programs and things like that, but it's a very, very small percentage. Most of the money that is left over in that medical loss ratio goes to pay for things like sales and marketing and underwriting, and for profit. There's a small amount that's actually devoted to care management and things like that.